So my name is Walter Peters, and you're here at the Naked Forex webinar. I'm going to talk today about spikes. Before we start getting into spikes, I just want to make sure that you know that if you enjoy what we talk about today, this naked trading stuff, you may be interested in the Small Accounts, Big Profits course, which you can get in by clicking the link above or below this video. And in that course, I'm going to share with you how we trade naked, how we use risk to get really aggressive. And we're going to try and ramp up a $1,000 account to $100,000 as quickly as possible over about 300 trades. So that course is available right now if you'd like to click the link above or below and get in on that. Let's talk about spikes. Now, what do I mean spikes? Well, spikes are when the market gets a little bit excited and a lot of people are kind of piling in, and what that ends up looking like are these wicky candles. And there are a couple of different ways that I like to identify these and use these to set up trades. Let me share with you what these look like. So these spiky charts are typically high reward to risk ratio trades. Well, they should be if you manage them correctly. And the other interesting thing about these is, well, I mean, by definition, if you are, I believe this to be true about the markets. And I think if you have a think about it or test this out for yourself, you'll see what I mean. Typically in the markets, there's always yin and yang. For example, if you wanted to improve your win rate, probably the easiest way and the most direct way to do that would be to reduce your reward risk ratio, and vice versa. If you want to increase your reward risk ratio, it's very likely that your win rate will suffer, and you'll pull win rate points, so to speak, off the table if you go ahead and add, so to speak, reward to risk ratio points in, if that makes any sense. So if you have a 2-to-1 system and you're running that 2-to-1 system at a 45% win rate and you bump it up to 3-to-1 reward risk ratio, you'll probably see that fall from a 45% win rate to a 38% win rate or something like that. That's typically what will happen. And so when we're looking at these opportunities in the market where the market's really spiked and had a really strong move, the interesting thing about these spots is that it's really hard for you to go against the recent move. The recent move is so strong and so powerful and so fresh in everyone's mind, it sometimes is difficult to go the other way. Now, having said that, it is also true, and I know this from testing traders around the world, it is true that most traders around the world typically prefer to trade those setups where they're trying to get in on a reversal. And what I mean by that, and we might as well just start bringing up some charts here. What I mean by that is this is the 12-hour pound Aussie chart, by the way. So, and it says offline, but it's actually online. These you'll see these little moves. It will move just as often as the 1-hour chart. So this is the same chart here, but it's the 1-hour version. You can see it's at 86.47 and ticking up and down around 47.46. Same thing happening here on the 12-hour chart. So it's actually live. It's pulling in live data. It's not a dead chart. So on this 12-hour chart, what I'll do is I'll give you an example of what these spikes look like. I'm going to show you a couple I think that are really easy to spot. And a lot of traders, as traders, we like to find turning points. It's unnatural for a lot of traders to go with the trend. Some traders do, but 8 out of 10 traders would rather go against the trend. And if you ask a trader who says, no, I really like to go with the trend, oftentimes the only reason why they say that is because they've been taught, and it's kind of beat into us as traders that we should go with the trend, which is interesting in and of itself. But anyway, that's a side note. Let's talk about these setups. Now, what I may decide to do here is actually go to a different chart. Now, my computer, I just got this computer today late last night actually, because my other one died. So what that means is what I'm gonna do here is I'm gonna remove this I'm going to remove this indicator and I'm going to switch this up just a bit and save this as a new template just to save myself some time later. Okay, and we'll make these bearish candles a little bit darker. How about like that? There we go. Those are some bearish candles if I've ever seen any. All right, so this is the Euro daily chart, of course, and what I'm going to look for here are some examples of what we're looking for in these sort of spiky markets. I could certainly go through Forex Tester and share with you what these look like kind of in real time, and I'd like to do that. However, like I said, this computer I'm just putting everything on it, like all my platforms and Forex Tester and things like that, so it's not quite ready. But interestingly enough, this is the Euro daily chart that you're looking at, and I'm going to save this template. Alrighty. Might go to the 4-hour chart. Might be easier to find some on the 4-hour chart. This is actually a great example of one right here. All right. So let me zoom in on this spot right here, and I'm going to give you the rules. If you have any questions, let me know as we go, okay? So what you can do if you want to use Forex Tester as sort of a testing software, you can actually load up your chart like I have and then just push the F12 key, and the F12 key will advance your chart one candle at a time, Forex Tester style, which is pretty cool. Okay, so this is the interesting thing about this setup is you don't necessarily have to use it as a reversal setup. In other words, you could use this, and that's what this example is going to look like, and you'll see why I'm mentioning this. You could use this as a reversal for a retracement move. So notice how this market's making lower highs and lower lows. So this is a low, this is a lower low, this is a lower low. There was a high over here, right here. There's a lower high right here, and there's a lower high still right here. So what I want you to notice here is this. Even my arrows are too small. Everything needs to be changed on these charts. Okay. So this touch right here, first of all, I want you to notice I like to use support and resistance. I think it's easy for many traders to see that there is support here, that there is support here, and that there is resistance here. Okay? And there was a little bit of support here. You could certainly also make the case for resistance here and certainly for support over here, right? So what that's saying is that somewhere around this level, the market has a memory and tends to bounce. Now there was a quick fall through here and it popped right back up. This is what we call a blow off bottom. So the market kind of blew through the bottom and then hopped back up. And remember, this is a 4-hour chart. So if you added this candle and this candle together, in other words, you made an 8-hour candle, you would have a kangaroo tail, wouldn't you? Because you'd have the open and the close in the top third of the candle. There would be the open, there would be the close. You would have the high here. You would have the low here, I believe, that wick. And it would have penetrated the support and resistance level. So that in and of itself would have been a signal. And after the first 8-hour candle, which would have been these two candles, and then the second 8-hour candle right here, you would have actually traded higher. So a buy stop would have been triggered, and it would have gone up a little bit. But because you were in a downtrend, it didn't really go up that far. So let's say that I see this area and identify it as a nice resistance support level. And so I've drawn my 3640 level on my chart, and I see that the market rams back up here, and it seems to make what appears to be a high, and it's pulling back. Now, so in my estimation as a trader, I have to decide what's going on here. Either the market is starting a new well, there's more than. I actually almost made a thinking mistake. So you probably know about cognitive biases, and I think they affect our trading quite a bit. But one of the ones that I just almost fell into right now, because it's such a common one for traders, is false duality. False duality is when we think, oh, it's going to be this or it's going to be that. Well, actually, there's a whole multitude of things. It's not just this or that. It's easy for me to look at this chart and make the decision that either this is an uptrend, these strong candles going up, and then this pullback is a bullish flag, and then it's going to make another strong move up, or that this is simply a pullback in the midst of a downtrend, and this pullback is going to be over soon. But actually, there are a lot of other things that could happen. For example, it could go up like it did here, pull back, and then gap up and just rocket up. It could come up here and then pull back and then gap down. It could come up here, pull back, and sit here and just print a bunch of candles inside a tight range for like a week. There are lots of things that could happen. So false duality is when we think, well, it's either going to do this or it's going to do that. And well, that's not technically true. There are lots of different things that might happen here. They could cancel the euro. They could cancel the euro and it would just flatline here and just say, well, everyone who's got euros, this is the exchange rate and it's fixed, and turn your euros in for pounds or Swiss franc or US dollars or whatever you want, and the rate that it's at right now is pegged at. I mean, really, there are a whole bunch of things that can happen. However unlikely we believe them to be, they're actually, many of them are probably more likely than we would expect. But that's the topic of the Black Swan book by Nassim Taleb. If you haven't read that, it's a great book. So I'm looking at this, I'm thinking, well, it could be a pullback during the midst of a strong bullish trend, early stages, or this could just be another lower high, and it's actually going to take out this low here, and it's going down. So what I will do here is I'll say, well, to answer my question, I want to see what it does. If it does indeed come back to 36.40, what is it going to act like when it gets there? So I hit my F12 key, I advance my 4-hour candles, and I'm there. That's interesting. We've come back right away. So are we going to break through, or is this a double top? Now, one of the things I look for on breakouts, when I see the market hit support and resistance repeatedly, I sort of expect that if the market hits support and resistance repeatedly, and maybe like 10 candles are on this support level or the resistance level, or whatever it is on whichever side of the level it's on, it doesn't really matter. If there are 10 candles and 6 or 7 of them keep touching the level, I kind of assume it's probably going to break out. It doesn't have to break out, but that's more often than not, I've noticed that that's what's going to happen. Your testing may show something different, but that's what I found. So if that's the case, if it is going to break out, then it should have probably sat here. So the fact that it hit it, pulled away, and came back up suggests it could be a double top. Now let's see what happens next. I don't really know either way right now with this candle. I want more information, so I'm going to wait another 4 hours, and then I get this. Now, it's tempting to look at this and call it a kangaroo tail, but officially it's not. And the reason why it's not, if you may know the rules of the kangaroo tail. So a kangaroo tail is when the open and the close of the kangaroo tail are in the bottom third of the candle. Well, that certainly is true. It is, for me, when they print on a support and resistance level where typically the head of the kangaroo is on one side of the level and then the tail extends through the other. Well, that's also the case here. And finally, the open and the close are contained within the previous candle's range. That's not the case here. You can see the close here is at 1.36 even, and the low of the previous candle is at 1.3603. So it actually misses being inside the previous candle by 3 pips. Now, typically, these would qualify as pseudo kangaroo tails if the previous candle was so small that it was hard for the open and the close to print inside of that previous candle. And that would certainly be the case here. So this could qualify as a pseudo kangaroo tail. But however, given what our topic is today, I want to talk about something else. There's another way to see this, and it's a special case of the double top. Obviously, you could also trade these as double bottoms. And the reason why this is a special case is as follows. If you've read the Naked Forex book, it doesn't really matter to me if you have or not. If you have, thank you for the 65 cents that the author makes on their trading book. That's brilliant. I hope it helps. I get emails from people all the time about the book helping. But in the Naked Forex book, there is a system or a setup, really. It's up to you to make it into a viable system and add your exit strategy and all that. But it's called the whammy or the moolah. So these are double tops and double bottoms. And basically the second touch has to be lower on a double top or a moolah, and the second touch has to be higher on a whammy. There are a bunch of rules associated with it, but that's the gist of the double top, double bottom. Now, this would not qualify as a moolah. Why? Because the high of the second touch is much, much higher than the high of the first touch. So by definition, it is not a moolah trade. However, what it is a ghost peak. Now, ghost peaks didn't make it into the Naked Forex book. So this is something that if you have read Naked Forex, you wouldn't have come across a chapter on this. Now, this is what a ghost peak is. A ghost peak is when the market hits a support resistance level and then it pulls back and then hits it again, just like any other double top. However, the special case is this. So I'm going to write these rules out for you. So now is a good time to take notes if this is the sort of thing that you do. Number one, the first touch has a higher close. So first touch has a higher close. First touch is the higher close. Number two. Oh, sorry, I didn't mean to show you the the results here. That was not my intention. The second touch has a higher high. So let's just review. That's definitely the case here, isn't it? Because the first touch has a higher high. The second touch has, the first touch has a higher close. The highest close of the first touch is this white candle, and the close is at 1.3646, which is exactly where I've drawn this red line. So the reason why I've drawn the support and resistance level at 36.46 is because it just kind of matches up with the close of this candle. I probably would want to draw it slightly lower than where I've drawn it right now, but I'm just doing that because I want to mark the close there. Now, that's also going to be an important spot because we're going to use this line in the sand sort of thing as a way to manage this trade, as you'll see in a moment. So number one, hey, Thomas, great to have you here. Number one is your first touch has a higher close. So what's the highest close on the first touch is right here. Where's the highest touch on the second close? The second touch. Well, the highest close on the second touch is all the way down here on this little white candle. So far, anyway, we don't know what's going to happen next, but so far we've touched here, and the highest close at 36.25 here, and the first one is all the way up to 36.46. So certainly the first close is much higher. Now, the highest close on the first touch is higher than the highest close on the second touch. Now, again, like I said, we don't know what's going to happen after this, but it certainly looks like it hit it here and it hit it again here. Now, the second touch has a higher high. Another way of saying this, why would I word it so weird and say the first touch must have a higher close than the second touch and the second touch must have a higher high? Basically, what that's saying is there's got to be a long wick. That's another way of saying the second touch must have a long wick. Now, by definition, this pseudo kangaroo tail has a pretty long wick. So what we're trying to do here is find one of those. Well, let me ask you a question. Let's say that you sold the market right here. Here, I'll take this arrow and I'll stick it right here. Let's say you sold the market right here, where the market hit this support and resistance level right there. If you sold the market right there and then you watch the market fall like this, where would you have put your stop? Well, the answer in most cases probably is going to be right about here. you're probably going to put your stop somewhere in this area right here. So I'll make this like a, what color should we use? Some sort of pinkish something or other. So I'm probably going to put my stop loss right there. If I sold off this touch and I see the market go, I'm like, yeah, I'll put my stop up there and it'll never hit it again. Well, it came back up, and let's say that I survived that touch. And I thought, yay, everything's fine. And then this happens. This spike has gone up here, and it's cleared out all the orders here. Not only are there orders here, stop loss orders, for the bears that sold off this touch, and they, might have sold on the 1 hour chart or the daily chart, or I don't know, whatever, 30-minute chart, who knows? But they put their stop loss up here, and then when this touch happened, and actually over here too as well, with both touches, you would have trend followers, traders who like to trade the trend. They're waiting for a new high. And so they're going to put buy stops here as well. But their buy stops will be entry prices. They won't be stop prices. So in a sense, they're going to get them into a trade. So you've got the bears who put their orders here, and you've got the bulls who've put their orders here because they want to go long and they think it's going to be an upside breakout. So there are a lot of orders here. And the fact that this candle stabbed into them and cleared them out, that's a good thing, because we've stopped out these bears over here. And now we've also pulled in the bulls, and we've tanked them. So they're in trouble too. So now, basically, we know that this candle has eaten up a lot of the liquidity. So now, what we're saying is this could be an exhaustion, and I want to go short on the close of this candle. So as soon as I get a ghost peak candle, and obviously for a ghost valley, you would have the exact same rules in reverse. If I were to get a candle like this, I would actually be pretty keen to short. And according to the rules of the ghost peak, I would short on the close. This is very different to normal kangaroo tail trading where you would put a sell stop below the low here. I'm actually going to get in on the close of this candle. All right. So I go sell on close of signal. So the signal candle is in this case that candle that makes the higher high but has a lower close. So the lowest close on this touch is actually the bullish candle here. Or sorry, the highest close is on the bullish candle here, and it's much lower than that one. So this qualifies as a ghost peak. It's as a nice long tail, and ideally the tail will be much longer than the other touch. I mean, technically, if it goes a few pips higher than this touch over here, it will qualify, but that's not like the perfect sort of ghost peak. So then I'm in on this setup here. And so where do I put my stop? Well, here's where it gets interesting. I will use, if you've read Naked Forex, in the Last Kiss system, we use an emergency stop loss, and then we use an exit rule. And the exit rule will get you out of those trades most of the time, and only occasionally will you get stopped out at the full 1R loss. So a lot of traders I've heard from, in fact, I met one in London, at our London conference, and he was saying he loves the Last Kiss because it's such a great strategy for reducing your losers, and it is. And actually, Ghost Peak and Ghost Valleys are the same, and I'll tell you why. The reason why they're so good is because you will get out of this trade as soon as the market closes above this line right here. Remember, this line is identifying the highest close, which is on the first touch by definition. So if the market now makes a move up and closes above this line, so in other words, it makes a close that is now higher, this is no longer a double top, is it? It could be a triple or quadruple or quintuple or whatever top, but those don't actually, they're not very reliable, according to my testing anyway. So I don't like to trade triple tops. Double tops are about as good as it gets for me. So I don't want to be short after I see the market come back up here. Really, it should move away from here. And if it moves away from here, I think I'm going to be right. So what I can do here, I could put my stop loss all the way up here at 36.92, well above the candle high here. I could definitely do that, but I don't have to. I could also put it over here in this area at 36.65, for example. And if it's at 36.65, if I'm getting short on this close at 36, I have 65 pips of risk. So I have 65 pips of risk, but again, I'll only get out at that emergency stop loss level if the market spikes up there and hits it. If it just closes a little bit above this line, I'll also get out of the trade. So that's a way to reduce the average loss, and so the average loss won't be 1R. It should be less than 1R. Even if you get slipped on some of these, even if some of them gap over your stop and really go against you, you should have the majority, or at least around half or more of your trades are going to be the ones where the market went to that level and closed above it. And so you're wrong. The trade's not going to make money, but at least you don't lose the full amount that you had calculated as the risk capital. So in this case, let's see what happens next. You can see here, it trades lower. So if I had a sell stop here with the normal kangaroo tail, I'd be in, but I'm already in here. Let's say that I want to, target down here where there's a bit of resistance here with these candles and a bit of support with these two candles. So it's gonna not touch it, is it? Is it? Yeah, it does. So it gets me. It gets me out right here. So in this case, that would have been 113 pips with 65 pips of risk. So not quite 2-to-1, but this was a long-tailed candle for number one. And number two, I didn't have to put the stop loss 65 pips away. I could have put it a little bit closer, but I just wanted to give it a little bit of cushion in case we did get another spiky candle, and we did. It was just much lower over here. So those are the rules for the ghost peak, and I'll just put on here number 4. Stop loss above highest close, and exit trade if the market closes above the highest close, but doesn't hit the stop, obviously. It might also hit the stop, but if it doesn't hit the stop, you get out anyway. Exit once market closes above highest close, which is obviously that candle right there. So does that make sense? Is everyone cool on this? Is this making sense? What we're trying to do here is take advantage of the double tops or double bottoms where the market gets really excited, and a lot of people thought this was a breakout here. There were a lot of orders here. There were stop losses from the people that sold here and the people that sold here and so forth. And so now we've got people who are like, yeah, it's the breakout traders and the trend followers are all really keen to get in. And so what happens is all those orders are kind of like a magnet for the market. It sucks it in there, and then it totally reverses. So in this case, the market hops around a bit. Let's go find another one. I can give you an example of here's one. Is it? No, it isn't. Does everyone see why this one? Well, first of all, it's a range-bound market. So it's not like the market had been falling, and then it made this, nice double bottom. Really, what I'm looking at here are these. I'll show you so you know what I'm talking about. So this touch and then this touch. The reason why this is not a ghost valley is because the lowest close is actually on the second touch, right here. See this candle right here? Or actually it might be this candle, but either way, doesn't really matter. Looks like it's actually this candle. This candle has the lowest close, and that's much lower than that first close over here, so that does not qualify. And ideally, it doesn't really, and this is another one. You have this first touch here. There's your lowest close. But look, as soon as you get a lower close on this candle and this candle, it's probably going to go lower, and it does. So what we're trying to do is take advantage of the fact that the price action is hinting at what's likely to come. Here's another one. This would not qualify as a double top because we have a higher close here. It did fall away, but that doesn't matter. It didn't fit the rules. It's nice anyway to see the market really kind of going in one direction before you get one of these. So if you're still trending, it's typically what will happen is it will start making a higher close in an uptrend or a lower close in a downtrend. So this one right here is what would be a whammy, but that would be not a ghost valley, right? I want to talk about I would like to show you a Ghost Valley example, but if I don't have one, looks like we do have one right here. So this would be a Ghost Valley. This is nice because the market's been falling quite hard. So does everyone see where this one is? The lowest close is, I'll zoom in on it so you guys can see. All right. So the lowest close is this candle right here on the first touch. If you look at the line chart, you'll see that this is actually a really nice touch 1, touch 2, and then it kind of double bounced there. But, you know, we didn't know. Yeah, here we go. Yeah. This one right here. This almost would qualify as a potential breakout because all of these candles are actually touching the level. I might not even take this one. In fact, I probably would not have, just because all these candles are touching it. But technically it is a Ghost Valley because this has the lower low. It's much lower than, what's this low right here? 2880, and this one is 2885 and 2888. Okay, yeah. So this one's 3 pips lower than that wiki one, but the lowest close is there, and then the lowest close is going to be probably this candle right here, or maybe that one. So it is a little bit higher, and the market did go lower. So in this case, we might put our stop loss all the way down here at 2886. You get in on the close of this candle. Look at that. So here's the great thing about this. It's got 65 pips of risk, same as the other trade. But if it had messed around here and fell down below this line here and closed down here, I'd be out at, 15 pips of loss. And that's really what's so great about this style of trading is you lose out on these really terrible on the terrible trades are really small losers. This went up quite a bit. It went up to this level here where there's some resistance and right here. So both of those would have made possible targets. This call also have made a target, but didn't quite get there until after this nasty pullback. So that's an example. I want to share with you another type of setup, if I can find one. It's kind of rare, but let's see here. Oh, we almost had one right there. Actually, technically we did have one. Okay, I'm going to get rid of all of my support and resistance levels here. And then I'm going to share with you a bonus one. And then if you guys have any charts you want to have a look at, let me know and we'll take a look, okay? So you can start putting your markets in the chat if you want to have a look at some of the markets. But I want to talk about this other spiky reversal. So this is one right here. It's kind of rare. You don't see a lot of them. You will see them a lot in equities, like indices. They happen. I mean, they can happen anywhere. They can happen in any market, but they're not as common as the Ghost Peak or the Ghost Valley. And what it is, it's called a parabolic uptrend. And to make it work, to capture the market moves, you actually have to draw these trend lines have to get steeper and steeper to kind of capture the move. And so that's how you know that you're in a parabolic uptrend. Because see how this first trend line captured the move, and then you go, oh, I have to make a steeper one here. That's a clue that maybe you're going to go parabolic, and then as soon as it did this, you definitely went parabolic. And they typically will collapse rather quickly. So what you're looking for is a really wicky exhaustion candle. And in this case, you have one right here on March 19th. How about that? It's about, that was 2009. That was about 10 years ago to the day. How about that? So let's zoom in here. So here's your uptrend. You're going, yep, we're in an uptrend. And then it moves away from this trend line, doesn't touch it again, and starts following a different one. And then it moves away from that one and hops way up here and starts making a different move. And so really what happens is you're looking, once you get 3 or 4 of these trend lines, you know, okay, we're in a parabolic now. So then what you're looking for is some sort of wicky reversal. You have a kangaroo tail right here, right? Now, there's really no way to know how to draw this trend line. Drawing it right here, I think, there's a little bit of hindsight bias in that. I actually think that you might be better off, or might have been better off kind of drawing it like this and capturing this touch and then that touch. And so at that stage, when you see this kangaroo tail, that's actually a pretty good sign that it's getting wicky. Maybe this one or even this wicky candle. And you think, okay, this could be a reversal here. Now, it'd be nice to have a ghost peak here. I didn't get one, though. But I could have just gone short on this kangaroo tail. I would have been triggered on the second candle here. Pull back against me. My stop loss is up here, remember? And I'm still okay even with this pullback. And so finally, I fall off the cliff here and all the way down to this area down here. So this is one of those moves, these parabolic moves. You don't see them that often. When you do, they are lovely because the market moves really, really hard. Here's another one. And where are your wicky candles? You might have gone in maybe on this one, I don't know, or this one. You get stopped out. That's okay. Take another crack at it. By the time you get these two candles, that's a pretty good sign that you have two wicky candles. In fact, here's our trend line, right? We have trend line number 1 is right here. Trend line number 2 is right. What? Here, trend line number 3 is right there. Trend line number 4. Usually you'll get 3 to 4 in most cases. You get 3 to 4, and once your trend lines are almost like vertical, you know you're in trouble. You know you're in big trouble. So, yep, that's what it looks like right there. And see, I had a wicky candle there, and I had a wicky candle there. I might have sold off of one of these maybe, but these are excellent actually. This one is great, and then after that one, that's a pretty good. That's a pretty good sign that maybe we're onto something here. These two candles together, and then it breaks through the trend line, breaks through the next one. You know you're off to the races, and typically it will fall off pretty fast once it breaks the parabolic uptrend. Okay. Any questions about this? So those are the two that I wanted to share with you. Waiting for a wicky candle or two after a parabolic uptrend, which is defined by steeper and steeper trend lines capturing the price action, and then the other one, which is the ghost peak and ghost valley setup, which is a special case of a double top, double bottom, as I discussed before in the rules. In case you're wondering, where are those rules? Where are them rules? There they are right there. There are them rules for those of you that want them. Again, you will reverse these rules for a ghost valley. First touch has a higher close. Second touch has a higher high. You sell on the close of the signal candle. The stop loss is above the highest close. And then you get out once the market closes and makes a new higher close. So, or hits your stop. I like to go for pretty aggressive targets. I wouldn't. You can use pretty tight stops on these. I know that the examples that I gave you had pretty wide stops, but that's kind of rare. You can actually use pretty tight stops on these. Sometimes you'll have the candle close within a few pips of that of the higher close, you know, the touch before. Sometimes it'll be like really, really close. And if that's the case, you're in a great spot. Like here, there's too many touches on this level, so I wouldn't do that one. But let me see if I can find an example of what I'm talking about. See here, look at this. This is a great one. I know the market wasn't moving down and didn't make a double bottom here, but this is exactly what I was talking about here. So here's your first lowest close right here. So it is at the, what level is it? 49.02. And then this close right here, which is a lower low, but look where the close is. Close is already higher. So that is the signal right there, 49.06. So you literally have 4 pips to play with. And it's really scary. And to think there's no way I can do this. I can put my stop loss on the other side of the wick here. And I go, okay, well, my emergency stop loss is, what is that? 20. 26 pips away on a 4-hour chart. I have an emergency stop loss at 26 pips. So the market moves in my favor, pulls back, does not stop me out, and does not close below this level. And look, I hit this level easily. I hit this target right here, and I don't know what that would be, but that would have been a pretty darn good result going up to here. 26 pips of risk to make 80. So that's pretty good if I had just done that. So that's better than 3R, and that's what I'm looking for on these. And yeah, it's super scary when you see this. And I don't think this is the perfect setup because the market actually is moving higher. This would be more of a pullback double bottom than a reversal double bottom. But this is exactly the kind of setup that you'll see. You'll see these and you go, a lot of people are thinking this is a really weak move. But a lot of the times when you're in a trend, the last retracement candle is the scariest one. It's the one that really kind of shakes a lot of people out of the uptrend. And in fact, that's what would happen here. And then it takes off and goes higher. Finally, it does fall out. So that is the Ghost Peak, Ghost Valley, and the Parabolic Spiky uptrend, downtrend. Parabolics can go both ways. I know I gave you an uptrend, but they can go down as well. It's not just up. And you'll find them all over the place. So I want to talk about the charts that I like, or the trades that I like. Here, I'll share with you really quick before we shut down. I'll share with you my 12-hour charts. So my Aussie Kiwi, Aussie Singapore, and Euro Singapore trades are the ones that I'm in right now. So I'm in a short right here on the Euro Singapore. Kind of hoping that it's going to fall away here. I'm also in a short on the Aussie Singapore, which is behaving a little bit better. And the numbers are pretty good on these Aussie pairs. A lot of people are going long. I expect it to actually fall through this little mini trend line soon, and that'll be another reason to perhaps add to that. And then I've got a Aussie Kiwi short as well. And that's looking all right. Again, sort of in a retrace move right now. But I'm basically holding on to those three trades right now, and I would like to take well, I'll put it this way. Oil is really interesting to me, or was interesting to me. If it bounces here, that would be very interesting. If oil bounces hard right here and we get like a wiki candle, this current candle, you can see it closes in 194 minutes. Or if we get the next candle kind of engulfing it and rocketing back up, I may go long oil. That would be interesting to me. So I'll be watching that one. And S&P, not too sure about doing anything on the S&P. So, yeah. I would like to short the Aussie too. The Aussie looks great for a short, which is right here. But again, I think the key on this is going to be wait for it to break this trend line. Once the Aussie breaks this trend line and closes below this trend line, that would be a drop trade, and I would be pretty keen. Again, what's nice about this is we have a really, really clear level down here. We know that 67.30 is where the support's going to come in at, or 67.40, right around here. We know that's a pretty good target now that the market's shown its hand here. Pretty good. You can trade these on 15-minute charts, Marcel, of course. Some traders actually like to use indicators as well. I don't use them, but what they look for is divergence. So I know that some of my students, what they'll do is they'll look for double tops, double bottoms that are ghost peaks, ghost valleys, and they'll look for divergence as well, if that makes any sense. So, for example, let's take a look at the New Zealand CAD here. So here's it's probably going to look a whole lot better on the 4-hour chart, but let me see if I can bring up the New Zealand CAD on the 4-hour chart real quick. 4-hour. All right, let's see. Where were we? So basically what people do is they look for, here's one right here that would have been a loser. You can see the market closed back up here, but here, I'll share. It doesn't really matter. This one's a loser, but this is an example of the trade, of the setup, so I want to show you because they're not all winners. This is a great support resistance level here. Support, resistance, great. This is a first touch trade, by the way. That's a great trade right there. So now what happens over here is you see this. Let me share this with you. This is a great question. So here you go. Look, here's your first touch here on the level. And so your highest close is where? Highest close is right there. Highest close is on this candle right here at 90.69. I don't use divergence, Marcel. I think you can see divergence without using indicators. That's why. I know that sounds weird, but when you're looking at charts like, I started trading currencies in 2001. So I've been doing this a while. And I think a lot of traders will actually tell you can tell when there's divergence. I don't really look. A lot of traders do though. So they might use like momentum or stochastics or MACD or what doesn't really matter, RSI, whatever. So for example, this is the spiky one, and it is the highest close is in fact on this candle right here. It pulls back, comes back up here, and gives you your big spike. So you sell right here at 90.60, and your stop loss might be, your emergency stop loss might be up here at 90.84. So that's 24 pips of risk on the New Zealand CAD 4-hour chart. And let's just see. Now I'm curious. Let's just see if the RSI, for example, gives us any sort of... What is the RSI? Is it a trend? No. Surely not. It's an oscillator. Yeah, so there's divergence right there. Does everyone see what we're talking about? So there's the higher high on the RSI and the lower high on the RSI there, but there's actually a higher high on price, of course, because we spiked up. Now, this didn't hold, and you can see that this candle right here is where you get out. So what did I say my stop was at? 84? So I would get out at 79. So I would have saved myself 5 pips. But still, every pip counts, especially when you're looking at reducing your overall average loser. So that would have reduced my average loser by having a reason to get out right there. Okay? So again, I don't use divergent. I don't use that. I think you can kind of see it on the chart. But it's up to you what you like. And I can see why people use it, I get it. But I know a lot of older traders, they'll tell you that they can tell whether or not their signals would give them their indicators would give them a signal. And they don't even have, like, how you can pull up MT4 on your phone, and if you're not so good at getting the indicators, or you have proprietary indicators or whatever on there, and you just look at price only. A lot of traders I know that have been trading a long time, they'll look at the chart, the raw chart, and they'll know if the MACD is crossed over or whatever. They can kind of tell, which is weird, isn't it? But I think it's because you're actually, in the end, you're actually looking at the candles. Even though you say you're looking at the MACD, I actually think you probably put more into the candles than you would admit anyway. So there you have it. Thank you so much, guys, for spending time here today. I really appreciate it. I wish you happy trading. And if you'd like to join us in the Small Accounts Big Profits course, you can click the link below or above and get information about that. We're going to be using trading systems like this one in the course. And you can follow my trades, follow with me as we take a $1,000 account and ramp it up as quickly as possible. I wish you happy trading, and we'll see you soon.